Thank you very much, everyone, for coming along to listen to me. First Property Group is a company which I founded in the year 2000. We're an AIM-listed commercial property fund manager. And by that I mean we buy commercial property on our clients' behalf. We charge fees on the management of those properties, and the aim of the exercise is to make money for our clients and make money for ourselves en route. We do on occasion buy properties ourselves, and we do also co-invest in the funds that we manage. So we're a co-investing fund manager. What I'm going to do today is to trot you through our philosophy on commercial property, how that's kept us safe over the last 15, 16 years, and a little view of how we see the future and where people perhaps might be able to make money out of the UK commercial property market going forward. Without wishing to sound unnecessarily self-deprecating, our philosophy for investment in commercial property is really very simple. We target high-yielding property, and there's some very good reasons for this, born out of a priori as well as empirical evidence, a priori thinking as well as empirical evidence. First and foremost, property is an illiquid asset class. When the going gets tough, it's very hard to sell. And in order to maintain liquidity, the surest way to do it is to have a high rental stream. In the long run, it's not actually capital gain which gives rise to total returns. It's very largely income. So if you were to look back at the results of the commercial property market over the last 30 years, you would see that about 85% of total returns come from income, not from capital gain. And of course, if you have a high income stream, as an investor in property, you're much more able to tolerate reductions in value because your high income stream bails you out and protects your internal rates of return if capital values are affected. And the last thing, and it goes hand in hand with commercial property, is leverage. And naturally, the higher your levels of sustainable income, the higher the leverage you can put on a property, and the higher one would hope the total return is that you can generate for your equity. So income is at the heart of our investment philosophy. But we take a fundamental approach to investment. We don't just look at income in isolation. We don't follow consensus. It's very important to think from first principles at all times. There is a tendency, and I'm not wishing to sound glib or anything about my competitors, but there is a tendency for groupthink in the institutional property market. And when a theme establishes itself as the correct theme to be following, you often find people moving into it in herd sort of manner. And it's very important not to do that. And of course, hand in hand with thinking from first principles is the need to be flexible and change your strategy if your philosophy isn't working. And we try and do that on a virtual daily basis based on how we see the economy and the markets in which we operate. I'm just going to trot through our history to evidence some of the steps we've taken as a result of that very simple philosophy. 2001 was when we got into fund management. I had, until then, really been a property developer. And as a property developer, we would only really buy a property if I thought we could make a sort of 15% rate of return on equity or a 25% IRR. But in 2001, we had 9/11. And on the back of 9/11, which was a political event, it was not an economic event, the Bank of England cut interest rates, I think down to about 4%, going by memory. And in those days, you could buy commercial property on sort of 9.5% yields. Very good secondary property. And it became an absolute opportunity to make money. We could suddenly earn development type returns from investment property. I hadn't seen it in my life before then. And so we established our fund management business. And the first few funds that we established in the UK, as a result of that step, earned an internal rate of return of 23% per annum. But things changed very dramatically after that interest rate cut in 2001. And actually, I think, I don't want to get distracted from the main purpose of this presentation, but I think the interest rate cut in 2001 was perhaps the most pernicious interest rate cut that led to the boom and then the subsequent collapse in our markets. And actually, the writing was on the wall in 2005. I went into property in 1994, just after we came out of the 91 recession. And it became an unsaid, if not said rule, that you only ever bought property on a yield that exceeded the cost of borrowing, so that you always had a positive yield gap. In 2001, the yield gap was massive because the Bank of England cut interest rates, in my opinion, when they shouldn't have done. By 2005, property values had shot up remarkably, and you could hardly borrow money at less than the cost, at less than the yield in which you could invest it. In fact, we were burning cash buying property on that income-based philosophy. And so, sticking to our guns, we started selling property in 2005. We didn't see the credit crunch coming. It was just a simple mathematical formula. We couldn't see a positive yield gap between interest rates and the yield that we could make on property. The writing was therefore on the wall. I said in my chief executive statement of 2005, it's one of the quotes I'm most proud of, that the UK market was overvalued. And we didn't just say it, we acted on it, we sold our property. And as a result of that, we were pretty much out of the UK when the credit crunch hit. And as expert investors in the audience will know, the UK market was one of the worst hit across the globe when the credit crunch arrived, with property values dropping by about 50% or more. So our capital was preserved. In 2005, because we couldn't make money in the UK, we moved to Poland. And when I used to go to drink parties at the beginning of the credit crunch, and people asked me where it was that I was investing, and I said, well, you know, we've got most of our assets in Poland. You could see them rolling their eyes, thinking, oh my God, poor bugger. They must be taking an absolute bath. But actually, Poland has been a fantastic country in which to invest. It never went into recession. Its banks never played in the high-stakes games that German and British and other banks did. They had a healthy banking sector throughout, and actually we had a very benign credit crunch. But in 2008, we could see, after the collapse of Bear Stearns and before, in fact, the collapse of Lehman, you know, it was all obvious that we were in a credit crunch. We could see that the credit crunch was moving across from Western Europe to Eastern Europe. And we reversed our philosophy of only renewing leases at lease expiry. We used to believe, correctly, that in a rising market, you wait until lease expiry to renew because you're going to get the highest possible rent at that point. But we could smell, and actually in advance of most of our tenants, that the economic environment was about to change materially for the worse. So we approached the largest tenants in our portfolio early on in 2008. We increased leases as much as we could, and as a result of those increased leases, actually we were also able to put the rent up. So when the credit crunch did hit Poland, and it didn't hit Poland as hard as it hit the UK, but when it did hit Poland, we went into it with a very robust set of properties with long-term income, good covenants, and increased rent. The credit crunch in the UK was very severe. By 2009, property values had collapsed to about 50% of what they were. And we saw an opportunity to come back to the UK. The yield gap had opened up again. Most unusually, at the beginning of a downward cycle, the Bank of England cut interest rates again. So there was a big yield gap. And we returned to the UK and raised a new £100 million fund to invest in what we then termed recessionary resilient property. Though we knew the market had been hit hard, it was very hard to see how long that adverse environment would continue. So we wanted to target properties which would be safe for our pension fund clients for the long term. And we bought 21 properties worth about £100 million, yielding 7.5% to 8% back in those days. And they're still yielding about 7.5% to 8%. So we've had no capital gain out of that portfolio, but a very high income return on an unleveraged basis for our pension fund clients. Then in 2013, and this really exemplifies the importance of thinking from first principles, the coalition government at the time, and indeed the Conservative government now, remained very keen on increasing housing stock. And under the Labour government, the planning system had become progressively more restrictive and more difficult. But under the coalition government, permitted development rights were introduced, and that streamlined the conversion of offices to residential, and you had an automatic right to convert offices to residential use. That law was first mooted that change in the law was first mooted in late 2012. And disregarding our entire philosophy for the pursuit of income, we started targeting vacant office blocks with no income across the UK, principally the southeast of England, that we did buy a property in Birmingham as well. And we were able, in very short order, to buy about 10 properties on an average rate per square foot of about £50 to £100 a square foot, get planning permission in very short order, and then flog them for a really stunning profit. So in a period of about a year and a half, from 2013 onwards, we earned a rate of return of 53% for the fund that we raised, and an internal rate of return of 98%. It's the highest rate of return we've ever earned. And it was on the back of a change in legislation, thinking from first principles, and discarding our philosophy for that particular fund. This is an example of a property that we bought. I won't go into huge detail on it, but I think no gossip is fun if you don't mention names, so I will mention names. We bought this property from Threadneedle, who are very capable asset managers. They bought the property in 2007 for 18 million, an office park in Uxbridge. We bought it from them in August 2014 for 7.8 million. We got permitted development rights, consent on it, and we sold it a few months later for 18.3 million. Threadneedle are slightly circumspect about selling us property at the moment. In 2016, this year, as everyone knows, we had the Brexit vote, which is undoubtedly the most evocative political event and has polarized people right across the United Kingdom. So leaving aside one's own personal views of whether we should be in or out of the European Union, what is important to note, rather like the 2001 interest rate cut, is that the decision to leave the European Union is not an economic decision. It is, at least at the point of the referendum, it was a political event at best. But we saw immediate loss of confidence in the market. We saw institutions immediately retreat from the market. Funny enough, the buyers of secondary property, smaller property companies and high net worth individuals were much more robust in the face of the referendum result than the institutions were. And I have my own theories about that, but the institutions retreated rapidly from the market. And our response to that was, well, actually, the United Kingdom's economy is robust. We saw no obvious immediate adverse consequences from the vote itself. And we raised another £50 million from one of our clients to go and buy, this time, institutional property. Typically, we buy good secondary property, but because it was the institutions who were sitting on their hands, we bought some supermarkets and retail warehousing schemes, which typically we wouldn't be able to afford with our high income approach. And this is something we bought. And it's quite interesting to look at this. So this is a retail park in Southampton. The biggest problem we have with this park, having bought it, is that we don't have enough cars for the shoppers there, which is a nice problem to have for an owner of a property. We bought the property on a 6.7% yield, and we immediately sold part of it for 5.35% yield, 5.4% yield. And the reason I tell you that is because it exemplifies the disconnect between the institutional market and the private market. We bought the property from an institution, it's a large lot size, but the private end of the market is still robust, and we could sell that at an immediate profit. In fact, it was a back-to-back deal. We got the sale in place as we were buying the retail warehousing scheme. So using our very simple philosophy, this is a chart which shows how capital values have moved over the last 14 years, just after we went into fund management. And we obviously bought a few properties in the run-up to '05. Then we sold very largely all those properties at the peak of the boom. Lehman Brothers collapse took place. We re-entered the property market in 2009, bought 23 properties. These properties here represent the permitted development rights offices that we bought, and now we're investing at that sort of level in the market. And what has this meant for shareholders in First Property Group? I've pitched Gervais Williams many times over the years to buy shares in First Property Group. So I'm going to have one more pitch at you, Gervais. What is our philosophy meant for the company? Well, that's our track record during the credit crunch. We've gone through the entire credit crunch with our net asset value growing and our cash pile increasing. Moreover, we haven't, like many of our competitors, had to do a rescue rights issue or any placing at all. And in fact, we've been able to grow our dividend payout to our shareholders quite substantially during the course of the credit crunch. And because we believe in income, we believe paying out income to our shareholders is equally important. And that's the performance of all the funds that we've managed to date and are managing. And you can see, with the exception of one small blip down, everything is in positive territory, notwithstanding having gone through one of the worst credit crunches in the history of the Western world. So looking ahead, where can we make money? Again, I don't want to return to the Brexit debate, but in our view, Brexit is going to be virtually neutral on the British economy. There'll be some gains, there'll be some losses. The politicians will play it long. There'll be horse deals done behind closed doors about which we will never know. But actually, our economy will go on performing because it is a good economy and it's in a good place at the moment. So we're not at all negative about the future of the United Kingdom. We think it's got a very rosy future. We think that Western central banks are committed to keeping interest rates low. So buying institutional property now while the institutions are feeling weak is a very good time to be doing it. And then the other thing to do, even though the low-hanging fruit from permitted development rights has really gone because it's been hoovered up over the last 3 or 4 years, what it has done is create a lack of good regional office property. And what you can therefore do is buy office blocks that in the past you wouldn't have touched because they were down the M4 corridor and tainted and unable to be let and so on. But you can now buy them, you can increase rents, you can find tenants. It's a much healthier market for offices. And we're seeing rental increases across our office portfolio. So our message at the moment is to buy institutional property, go up the lot size scale, buy institutional property while they're weak. The institutions are sitting on their hands. They will come back into the market because they have to. Cash is piling up and they're under pressure to invest. So you want to get in ahead of them and you want to be buying office blocks across the United Kingdom. And that is all I have to say.
Just coming back to you on your strategy going forward, and thank you for a very clear presentation which gave us a very good understanding of the business. Are you in any way concerned about the changing work habits of people? Increasingly people are working at home. A lot of new businesses are starting up in places like WeWorks where they can set up fairly cheaply and very flexibly.
Yeah, we have a very keen eye on the way working habits as well as technology is changing the use of properties. So just stepping aside from your question for a moment, I mean, looking at the retail sector, which has been very badly affected by changing technology and the way people shop and so on, we really won't touch the high street. We'll only buy retail warehousing schemes where rents are low. you tend to have discount retailers who can't all that easily be outpositioned by the internet. So that's our kind of predisposition, is to buy retail warehousing, not shopping centres and not high street. As far as offices are concerned, we typically buy, as I mentioned, good secondary office space. And good secondary office space is virtually impossible to build nowadays, because building standards are much higher than they were when this 1980s and 1990s product was created. And you can't create it now for the cost that it was in those days, and we are therefore able to charge much lower levels of rent in order to entice customers to come in, clients to come in, tenants to come into our properties, than the brand new, shiny, health and safety compliant, EU regulatory compliant, BREEAM rated new building. And the other thing that's slightly odd about technology and the changing working habits is that it kind of suits these slightly obsolete older buildings, because as technology becomes much easier to implement, and you don't need raised floors, you don't need suspended ceilings like you used to, you don't need those floor ceiling heights, you can actually have a much more fluid office environment, a much more cost-effective office environment. And so we feel pretty comfortable with the changing working habits and given the kind of product that we're buying.
Thank you also from me for a very clear presentation. That was really very opening up vision on what's happening in the property market. My observation is that London, we've seen that the values dropping. Institutions, you're saying, are the cause of that. They're stepping back, and so that's causing the property values in London to depreciate. I mean, we can see examples of companies like St Modwen Properties, who have a very big investment in the Nine Elms site. We see Hammerson selling one of their Oxford Street properties recently, where they had to. Well, they claimed that the valuation of it, they sold it 3 months ago, was in line with the valuation 1 year ago, but nevertheless, why are they selling it?
Yeah.
Do you see this changing fairly soon, or that London will continue to drop away and the regions, meantime, will quietly prosper?
Well, I think London for me has been an enigma all my working career. I've never really understood London as a property market. And I've understood it less and less as the effects of low interest rates and QE have had their effect on asset values. So you used to be able to buy prime London at about 5.5%. You can't buy it now really for less than 4%. And a lot of property in London is trading at less than that. So it's not a market, given our income-orientated approach to investment, that we would really happily come into. I think London has been in bubble territory for a number of years. I think it needs a correction. So the institutional step back from London, I think, is probably a reasonable step back, and London needs an adjustment. The typical pattern would be for London to drop in prices and then regional values to drop as well. But we can get much better yields in the regions, and as we all know, traditional patterns of behaviour cease to be the norm nowadays, and I think Gervais will speak much more clearly about that subject than I can. But so again, we're kind of thinking from first principles, and I do agree with you that the regions, if your property in the region is chosen well, should do better than central London at the moment. So when I talk about buying institutional property, I'm not really thinking about London. I'm thinking about the southeast of England, maybe up into the Midlands, and getting increasingly sceptical as you enter towards Scotland. Scotland is quite interesting because you can get a yield pickup. Everyone's worried about devolution. So if you don't fear devolution, Scotland can be quite an interesting market. But London's not our focus.
I think you've got property on the continent, haven't you? How much of your portfolio is ex-UK?
About half our portfolio is Poland, with a small amount in Romania.
And how is the interest rate? What is the interest rate environment?
Well, Poland is interesting because they've been quite canny. They haven't abandoned the zloty in favour of the euro, so they were able to depreciate the zloty during the course of the credit crunch. But the property market there trades in euros, and so our borrowings in Poland are effectively based off euro interest rates. And we have a most extraordinary situation in Poland where we can buy, and anyone who wants to join me on this journey can talk to me afterwards, but we have an extraordinary situation where we can buy very good property on 8-9% sort of yield levels, and we can borrow fixed interest rates at 0.2% for 5 years. And that's a pure function of QE and low interest rates. And it's designed, and the product of that is obviously not what QE was designed to do. Again, I don't want to get distracted by a political sort of debate, but the whole point about QE is to get trade flowing. But what it's done is enable leverage buyers of property to make a shed load of money, and that's not what it was designed to do. So it needs to be rethought. But anyway, that's the cost of our borrowing in Poland.
I'm going to ask about your general philosophy on leverage. How much do you use? What your sensitivity is if you get something wrong about the point in the cycle or the way things pan out. That leverage could be a double-edged sword.
Yeah, I mean, leverage is a bit like marriage. You have to take it. What's the expression? What does the vicar say?
Not to be entered into lightly or unreservedly or something. You've got to be very careful. My wife's here, so yeah. She'll remind me later, I'm sure. But you've got to treat leverage with great respect. Leverage has become a kind of moral issue. You know, a lot of the institutions to which I talk treat leverage like the devil. Leverage is not the devil. Yes, over-leverage caused the credit crunch, but there is an appropriate level of leverage for any given property. And I have used leverage throughout my career, and it's been a very good tool to boost rates of return and to magnify returns. The key is to use it wisely, not to apply it to, again, it comes back to yield, not to apply it to prime property. You can apply very low levels of leverage to prime property and come unstuck because the income cover simply isn't there. So when the proverbial hits the fan, you've got no downside protection. Really, the best product to marry leverage to is good secondary property, where the income is reasonably high, 7-8% in this market. Borrowing costs are down at 2.5%, and you've got a big gap to protect you, a big cushion in the event that interest rates rise or property values drop. And there are very few credit crunches, I think, where a bank will repossess the property if you're paying the interest rate on it. And so the income always comes to the rescue, at least in that respect. But every property is unique. Every property requires its own attention when you decide on the level of leverage that you put on it. And then, of course, once you've decided that, there's a whole host of other things you need to address, essentially being the covenants in the loan. And you can have sort of covenant-light loans, which is what we had in the lead up to the credit crunch. They're great if you can get them because the bank can't take the property back as long as you're paying interest rate, you're paying the interest on it. And then you have overly regulated, overly demanding covenants from a bank. And of course, those are the loans to be avoided because they can trip you up whenever they want to because they've got all sorts of tripwires, mostly LTV and debt service cover ratio covenants. And you want to avoid those. So you need to be, leverage in itself is a complete discipline. And I could give a sort of 1-hour lecture on leverage, but it is something we believe in. We do apply it to our properties, and we look at every property on its merits to determine how much leverage we put on it.
Leverage is securitized within each property, or do you have any cross?
No, our philosophy is you don't cross-collateralize. That again is a potential recipe for disaster. So all our loans in our group are non-recourse, sitting in SPVs, and if that SPV fails, that leg goes, but it doesn't affect the rest of the group.
With the market as you described in Poland, why would you want to invest in the UK?
Well, I think that the Polish market is great for the income play, but I think we can get some very good income levels in the United Kingdom with the prospect of capital gain at the moment through this, particularly focusing on offices. So we just raised a fund on behalf of St Catherine's College, Oxford, Christchurch, Oxford, Robinson College, Cambridge, of which I'm an alumnus, and there may be one other Cambridge college that joins the party. And it's a £30 million fund, and we're going to focus on buying offices with a view to putting rents up and or getting planning permission to convert to resi. Thank you very much. Thank you.